Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Tuesday, September 26, 2023. It is 10:16 a.m. as I'm starting the video, so I wanted to get one out early to you. And just let you know, I think this might be it. We haven't taken out that 3470 with conviction yet, or we're right on it right now. Remember, those for the last couple weeks, they've been my next two big levels to go, the red line. So we clearly took out the trend line pre and post Fed, and we're right on that August 18th low in QQQ. We've already taken it out in the NASDAQ 100. But I want to do this video, just a handful of things. You know, there's that list that I've had for months now. I call it the TTW, my things to watch list. And a lot of things just breaking down. And usually when that happens, I think it's pretty safe to say we're going to get that big move down I've been talking about, and these additional targets, and be able to eliminate that new high, or really, you can never 100% eliminate that, but pretty much take it down to very, very, very low odds. All right, so what am I seeing today? Well, we're still there, and as I like to say, support is support until unless broken, but it's not just QQQ or any one index or any one stock or one sector. It's SPY. SPY is taken out now, that primary uptrend line right there, the red line again, which would trigger the next big sell signal. Let me move this. That was the head and shoulders measurement. Zoom in quick. Or tight, you can see we're clearly below there on SPY. So breakdown in SPY, QQQ is right there. But more importantly, I'm looking at both the leaders, I did the Magnificent Seven yesterday, and I gave you my thoughts, told you, figured we'd come down to at least those levels that I talked about that are just below. There's a lot of, I've got different boards here. Microsoft, a lot of these are right at support. So if the market's going to do it, now's the time they need to step in, the bulls that is, and buy it up. But again, the evidence continues to build. There's Alphabet. So, I can make a case here and tell you, if you're bullish, look, a lot of these guys are right at support. But the bearish case, I think, is increasing. And I've always, in years past, I've used the analogy, it's like the DA's office. If somebody, if there's somebody charged or not yet charged with a crime, first of all, the DA has to have a fair amount of evidence before they can even bring charges. When they bring charges, and then the prosecutor has to then build a case beyond a reasonable shadow of a doubt to convict them. So this is kind of when you're looking, especially when you're a flexible trader like I am. Most aren't. I mean, the majority. I'm talking majority of traders, investors, even professionals out there alongside only. And when you're shorting, you got to be quick. Timing is everything. When you're only long side trading, over time, the market always goes up, and so you're going to get bailed out, even if you have horrible timing skills. If you're a long-term investor, buy a hold. But short selling, I love it. It's very profitable. Stocks tend to fall a lot faster than they rise. You just can't stay late to the party. You got to get in at the right time. You can't wait too long to get in, also, because those drops are pretty quick. If you sit there and wait for Kramer to tell you the market's on a sell signal, well, you've missed 90% or even 50+% of the move. And so likewise, you got to get in fairly early. And we've been layering in, and I've been showing you each level that increases the odds that the longer term bearish scenario play out. And that's what I'm doing now. I'm just going to go over a few more. So, okay, QQQ is, I was just talking, you might have heard the little alert going off. It just crossed below that level. The August 18th lows taken out now. So that's, officially we just took it out. It's not by much. And I've always talked about, you can undercut it. There's potential divergences. Same with the FANGs. Everything, you revisit yesterday's video. I don't want to rehash that. But let me show you what I didn't show you there, and what the things that stand out, especially in my things to watch list. One of those being, and again, I did a Google search. I'm the only one talking about it that I know of, the problems in California. What I could find when I try to do a web search of, using the terms California municipal bond market issues, problems, all I get is that Fitch just came out, this is Wednesday, the 20th, so not even a week ago, and rated California's GO bonds, those are the general obligation bonds issued by the state of California, as AA, and the outlook stable. So the rating agencies but of course they completely missed it in the financial crisis. I just want to say, but this is telling us something. This is the breakdown. This is, we took out that there was the lows back from October when the market bottomed mid-October, and again I'm benchmarking this against the MUB, the National Municipal Bond Fund. So it's telling me that California has problems that are beyond just rising rates. There's two things that will make a bond drop. Let's keep it simple. Two things: rising interest rates. That function is nearly immutable. Rates go up, price of bonds go down, and then the credit quality of the issuer of that bond. A bond can be issued by the federal government. Those are treasury bonds. It can be issued by state or local municipalities, states or counties or any school district, things like that. They can be issued by corporations, and then with corporations you have companies that are AAA rated, like Apple, cash flush, earnings juggernauts, all the way down to those junk bonds. And so obviously junk bonds are down, as they should be down today. So the one that really the only little asterisk there about when I just said that the two things that make bonds go up or down, junk bonds are kind of unique in the fixed income world, because they are more sensitive to the economic cycle. In other words, they trade in line with the stock market and not with treasuries and other bonds. They are less rate sensitive because their yields are already so high to begin with. They are much more sensitive to perception of the economy and the stock market as well, one hand in hand. And so you can check it out yourself. You can see, junk bonds are down today. Here's JNK down, and then Treasury bonds were up. Let me see if they still are. Yeah, TLT. So that's one thing there. I think there's a move coming upside, a trade to be made on the upside in Treasuries. I'm sharing that now as both a trade idea and what's going on with the market. So if the market, if it can hold this support, we're still there now. I just showed you a couple of the things right at or very near key support, and then the 200s below. So there'll be a bounce here soon. But again, the takeaway for this video, and I'll get to those other things in a minute, the bearish evidence continues to build. And so remember, I talked about this being one. I was ahead on this one as well when, just about everybody out there a few months back had declared, the rise in rates over and the Fed won the battle and inflation's done. That's just when, I couldn't guarantee it would happen, but I said it was something to watch. That's when rates started moving back up. And again, the stock market has ignored this until now. That's what you're seeing. The move. The last few weeks, there's been now more and more talk about oil. That's the rally in oil that just won't stop, and Treasury bond yields breaking out to new multi-year highs and all that. So this is again the stock market based on where Treasury yields are, based on where crude oil is. All these things are back to where they were when on. Or even in some cases with treasuries higher than they were when the market bottomed back in October, mid-October, for the very same reasons, the inflation worries and what it would do to the economy, high interest rates, high oil, and somehow they magically, this time around, it doesn't matter anymore. So you figure that out. Again, one thing, what will happen, there'll be a mean reversion. Now, with that being said, I think as it just showed you, Treasury bonds, here we'll look at TLT, you can look at IEF, you can look at a 60-minute chart. I think there's a long trade to be made right now. Because as I talked about before, there's a lot going on with Treasury bonds. There's the whole government shutdown worries coming up, everything like that right there. Again, how much of that's priced in to the market. But also, as far as the stock market goes, if you can strip everything else out, Washington's horrible fiscal mess, but if you can just look at the stock market, at this point, I think the odds favor a rally in bonds with yields coming down, bond prices going up. Because if the stock market craters hard, I think you're going to get that flight to safety bid from institutions selling stocks because they're over positioned right now, as evidenced by how stock market's a lot closer to its 52-week high than low, and If the other scenario is maybe we do see that marginal new high scenario, I still can't rule it out yet. I think we'll have, if we go much lower here, we'll have a stronger case for that. And the only way the stock market, in my opinion, is going to see a new high over the previous high. I'm talking the highs from back in, what was it, mid-July, I think in QQQ at least. Let's see here. That would be, this is a 60-minute chart. Go to the daily. Yeah, the mid-July highs. I think the only way that's going to happen, I feel pretty strong on this, is you're going to have to see Treasury yields reverse and get back down below that breakout they just made to new multi-year highs. And so it's kind of almost win-win. Yeah, Washington's a mess. The Treasury, they've got issues. Have to keep issuing new bonds. Their interest expenses going up. Blah 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 blah. But for the reasons I just said, I think it's kind of heads I win, tails you lose. Either way, I think they're going to see a rally in bonds. And let me show you. The 10-year is a pretty sweet spot, easy to trade, less volatility. If you trade futures, I don't have to tell you that. You can CN is your 10-year bond futures, and CB or your 30-year. There's the divergence right here on the daily chart. And then 60-minute chart, you have right there positive divergence as well. So there's a trade idea for you, and it's also a way to hedge, maybe or diversify, I should say. If you're short equities, short or long, you can trade it on its own merits or its own technicals, if you will. And there's a downtrend line. So if this breaks, this is what I could see in treasuries. Go up here, break out there, run up. That means that breakout to new highs and yields will fail, and you'll probably see a quick reversal in this trade here. So that's it. I like treasury bonds, 10 or 30 or 10-year. IEF I just gave you is the 10-year. What else I want to show you? Oh yeah, let's get to financials. Or let's get to my things to watch list. I'm just going to go in no particular order because let me just sort it by gainers and losers, and I'll just go through there, not cover the whole thing, pick some of them. This was a trade idea for you, Carvana, off that recent. We had a divergent high breakdown here, put in a divergent high, steep divergences. It continues down. That's in my things to watch list. Moody's. Here's the bond insurers or the bond. I have bond insurers and bond raters in here, rating agencies. Like Moody's, I just mentioned, I think it was Fitch talking about giving California that AA rating, which I think will probably come back and bite them because there's some problems there. The market is much more adept at sniffing out problems than the rating agencies, in my opinion. Always has been, always will be. There's Moody's. It's got some divergences, so it could get you up here. But the bigger picture broke down, back tests, and it's still headed down. It hasn't hit my second target yet. First target was already hit. So we'll watch that divergence. Again, like I said, the market, if it's gonna rally, it needs to do so soon. QQQ testing or just slightly undercutting that level, those August 18th lows. Let's look at some of the other things. Semis continue to sell off, move down. There's the rising wedge, divergent high. I think we can eliminate that marginal new high scenario now because I say that because we broke the trend line. This was the wedge we had here. There were sell signals all the way up here. Targets listed on different time frames, and it keeps charging lower. And this was one of the most beloved sectors out there. Everybody thought semis are just going to go up forever, and we'll watch that. I think I have NVIDIA. Well, let me just show you NVIDIA. NVIDIA is a big one. NVIDIA, when that breaks, the whole sector, due to the weighting it has in the semiconductor sector and the psychological importance. Big divergent high, sell signal 1, breakdown back test. Next sell signal coming to break a 403.30 and then 375, and then that trend line that's going to send it a lot lower for a gap backfill. So the minimum, I think we'll see this sometime soon, and that's another 24% drop to backfill. I'm talking about this big gap right here. So watch that one. That's one I'm watching. IAI broker dealer index. Rut-row breakdown right there today. This is why I'm doing this for you. There's a lot of these guys that I'm in here. This one's been a trade idea for a while here. It's headed down to T3. That's AMBC, AMBAC Financial, bond insurer. MasterCard breakdown. Oh, that's what, remember the two big ones, MasterCard and Visa, I've been watching. Said, breakdowns looked inevitable to me, and they have happened since. So these were both short trade ideas and still are very much so. but they just broke down. I mean, this is a big wedge, big divergent high, and it didn't just break down from the wedge, but we now failed that breakout. We had 1, 2, 3 triple top high right here, 3 distinct reactions, and it's failed. So that's what we call a bull trap, especially if we can get further away from there and help solidify that, then that's going to be pretty damn bearish in my opinion. Send MasterCard a lot lower. In this one, and as I said in prior videos, you can overlay MasterCard and Visa. They are going to mirror the S&P 500 because when the economy is strong, the stock market's going up. When the economy is growing, that is. When it's contracting, fears of contraction goes down, and these guys will go lockstep. Strong economy, more swipes, higher dollar swipes. Weak economy, fewer credit card swipes, lower ticket item sales, hence lower revenue to MasterCard and Visa that get a percentage of every swipe. Paychecks, okay, this is the employment market. Probably the strongest pillar the bulls had to, make their case for no recession or a soft landing at best, or no landing at all, was employment holding up. And I'm watching these payroll companies, and you can see what's happening. Big rejection there. I highlighted as a short here. It was very simple. You hit over a bearish PPO crossovers. Those were the blue lines. That alone, you would have had some, you could just swing trade the hell out of this stock, just shorting those, and then going long on divergent lows, things like this, overbought as well, and boom. So this one continues lower. What else I want to show? There's the PZC, as I was talking about earlier, just really starting to waterfall sell after taking out those previous lows back when the stock market bottomed. And again, as I showed you, MUB, I believe I showed you, is not even anywhere close to its late October or early November lows right there. All right, so that's a red flag, and again, it's California. We're not talking, like I said, or Arkansas, or pick another state that doesn't move the needle. Rhode Island, I don't know. All right, what else to watch? ADP, big payroll processor as well, same thing. This one I showed you, get these extreme overbought levels, especially with negative divergence. And then boom, boom, it's broken the uptrend line, it's headed lower. So this would be, again, it's the last pillar, in my opinion, and that of others who I, respect their work, is the jobs market. And when that buckles, that is always the last to go. And again, I've showed this to you before, and you can pull up Google search employment history, or employment data, employment charts, and macrotrends.net, and a lot of these sites have that, and you can overlay the S&P 500, and all recessions begin from extreme low numbers in unemployment. So it's really almost a contrary indicator, and it's been used as a bullish thing lately because we've reached those levels. And as I showed you on the chart, I don't have it queued up now. You can pull it up yourself. You don't stay there long. When you hit that record low unemployment, 3% range, whatever, it's usually like a one and done, and then boom, then the unemployment starts ticking up from there, and the recession comes. So that's that. And again, I'm just giving you just a lot of evidence here. Big one I told you to watch it. I haven't heard it being talked about. Clear, solid sell signal on JP Morgan, the largest and most important bank out there. Breakdown, hit that key 143.85 support. You can see lots of was big resistance here. Reactions all the way back there. So we hit it after the breakdown. We bounced back test, and we're back there again. So we're right on sitting on the edge of the cliff, guys. That's why I'm doing this video now. And because I am seeing more and more things breaking out, I am now less and less interested in gaming bounces. So speaking of that, so here's an example. Yesterday I gave you a bounce trade idea. Told you it was a 15-minute chart. Let me cue that one up. 15-minute chart of NQ. Showed you we had divergent low. Right, was it right here? Yeah, I think that was it. And so we hit the minimum target right there. That was the previous one. These were the targets I have. Let's see, that was 922. Yeah, that was the other day. This was yesterday's. So we hit, that's how weak the bounce was off this divergence. We hit the minimum target. And so my point is, these divergences, they are a big part of my trading, but I also use them to note when they stop working. The euro has been a great example of that. We've had divergences building in the euro US dollar, and there's just a bearish trend, and you have a positive correlation with the euro and the stock market. You go to the 60-minute chart, my goodness, this has just been divergence buildings from back here. And each little divergent low gave you a rally, but we kept going lower, and the divergences kept getting bigger and bigger, and they're still there. And at some point there's going to be a short covering rally in the euro, and the dollar will bounce, and maybe that's coming soon, so keep an eye on it. Like I said, the markets are at levels, we're at support right now, and we have we go not too farther, too much lower. We have the 200-day moving averages come in on the big tech stocks. But again, let me get back to what I was showing you. A lot of things breaking down recently that say, hey, be careful at this point with the count, trying to catch bounces at this point is what I'm kind of going for here and trying to convey to you. UPS, I'm going back to my things to watch list. ADP, I already covered, I think I covered, if not, there it is. ADP breakdown. JP Morgan, I know I covered just now. Again, big one. And if it breaks this level and starts heading to my price targets, there's a problem. There's a problem in the banking system. JP Morgan has just about every advantage that you can have in banking, and so watch this one, and of course watch the others as well. I've covered that. I've done the whole in-depth coverage on the banking sector recently. They're all breaking down. Bank of America broke the trend line. HSBC, not really. Wells Fargo. These are some of the bigger banks right on the trend line. The Canadian banks continue to suck wind. There's Royal Bank of Canada, TD, Toronto Dominion Bank, Citi. Look at Citi down. Here's one of the largest U.S. banks right here, and it's been testing, just like PCC a minute ago. I showed the California Municipal Bond Fund. It was testing its mid-October lows when the stock market bottomed, and then it broke down. So what business does Citigroup have to be trading down here at 52-week multi-year lows when the stock market's still just fresh rolling off multi-year highs? So there's problems there, obviously, or Citi wouldn't be trading down there, and JP Morgan wouldn't have recently broken down. Alrighty, a couple more home builders. Me, I'm just picking on these guys. It's back here. That's where I first started highlighting the sector as an objective short right after that breakdown. And it's playing out as expected. And in the trend, you guys probably picked up on this. I've been picking on the sectors that are the most beloved. I just watch the mainstream media, reading the financial media headline. What's your Barron's, a Journal, all these other sources. And just back here, everybody loved the builders, and 101 reasons why they were good buys, because the shortage, no retail or existing home sales were next to nothing, because nobody could afford to sell or wanted to sell and get rid of their 2.5-3% mortgages to get a 7, blah blah blah. So it was playing into the builders' favor. They were building as many homes as they wanted, or selling every home they could build, and so whatever. That was, again, that's the kiss of death. When you hear that, this move was what you were hearing about here in the media. And this is the way the financial markets have always worked. By the time you start reading about something, it's usually priced in already to the stock. And so anyways, it's played out. T3 hit. These are still additional targets. I don't see why they won't be hit. And then nothing looks to me like this trade's over. Copper is in my to-watch list. FedEx. FedEx actually hanging in there, but will get dragged down with the rest of the lot, including UPS, which I'll get to in 1 second. But here's Visa. Okay, look at that. I mean, just a beautiful breakdown, a beautiful wedge. It doesn't get any better than that. Nice and clean. Lots of clean reactions there. Big negative divergence, building. And then finally, one day those divergences start to play out for a trend reversal. So you have a sell signal. You have a failure back below this breakout level. This was a big level. Boom. Here, let me circle it. Circle tool, please. Boom, 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 boom. Breakout. A little whipsaw through there, but went right back there. Closed on it. And then now the breakout has clearly failed right there. and the wedge broke down. So again, overdo it yourself, over lazy. So with the economy, so we'll get a kickback rally here. We're coming up on the 200-day moving averages. Maybe we get that kickback rally today. As I'm talking, so far QQQ has just slightly undercut that 354.70 level, but it's above it now. So remember I talked about that. In this day and age, you almost have to expect key support levels get undercut to clear and wash out the stops, the nefarious forces, the powers that be, algos and market makers and all that. They usually make sure that happens. So, what you want to see to solidify that, or what I want to see, is a solid daily close below that level, and even better to see a second follow through red candle after that. All right, so I just want to point out we're still there. We're still in support. There's still the chance. There's still divergences on that 15-minute chart I showed you yesterday, and we revisited today. Still have 60-minute divergences. So if they're going to do it, they need to do it soon. There's that 60-minute chart of NQ I showed you yesterday. See, we're below the comparable August 18th low, but just right on it right now, or actually a hair above it on QQQ. I told you they're going to be priced a little bit differently. The futures in the spot index. And so there's still the divergence, still the potential for the market to rally here, but it needs to do it soon. And that's why I'm going over this video, showing you the things to watch. These stocks that are breaking down, they need to, get back above the support levels they just broke below. We'll go over a few more and then I'll wrap it up here. TIPT needs to just break this trend line. That should send us down, way down on that one. XRT, again, I've talked about this, retail sales. A lot of last earnings seasons, a lot of the earnings season that just passed, I should say, a lot of the retailers talked about how they've seen a shift away from bigger ticket, higher profit margin items to the lower ticket, more staples and less discretionary products. PSP, private equity, big shoe coming to drop there, I believe, along with the pension, public pension funds. And I'm going to put a level I see right about here. I'm just kind of eyeballing a level that needs to go to trigger the next sell signal there. AGO, another bond insurer. Rejection here, resistance, breakdown, back testing, and should roll over soon. At best, if it pops to equal or marginal new high, it's going to do so with negative divergence if it happens anytime soon. So this one looks to be headed lower. And again, it speaks to the municipal bond market if these guys do start heading lower. And why is that? Well, because if you start seeing more and more defaults, these are the guys that have to step in and pay. When the municipalities go broke or bust, they have to step in and pony up and take care of the bondholders on that. So one example is Paradise, California. You guys might remember that. The town was just basically wiped out by wildfires back 2018. And right after that, they defaulted. They didn't have the revenue. They had issued a bunch of bonds. Was back in 2009. And after the wildfires, the city was gone, so there's no more revenue, and so that's where bond insurers have to step in if those are insured bonds and pay. And so you don't have to have a wildfire take a city out. We go into a recession. Municipalities are generating less revenue. There's less business being transacted, less tax revenue on those geo bonds and or revenue bonds, depending on what it are. Like toll. Some bonds are called revenue bonds of toll, supported by bridge tolls or turnpike tolls, things like that. Here's a sector, my things to watch list 2. I've covered this one in the past. This is specialty finance. They have those niche, non-bank banks, if you will, or for example, you can see this one clearly broke down. It's just been selling hard. Put in that divergent high back here, rallied into resistance, and the sector itself is down 22%. So this is just helps to reinforce what I've seen. Is that many sectors, you can back out the Magnificent Seven and look at really the stock market, and many sectors are just in nothing more than a bear market rally, which appears to have run its course. So, the takeaway is, if so, we're going to go take out those October lows. But this has those companies like Rocket, for example. You probably heard of Rocket Mortgage. RKT, and just again getting rejected at resistance down 32%. That was bound to happen with mortgage rates going above 7%. UWMC breakdown, specialty finance company, and again more and more I could go through. You can see they're all rolling over pretty hard. All right, we're almost done here. Fallen is a bond fund. J&K is a bond fund. Junk bonds, I told you they're down today with the stock market. Had Carmart in there. AutoNation breaking down, coming off a divergent high. Life insurance, muni bonds here. Let's see, cars.com. Look at that. Again, all these were highlighted before. Big divergent high. Sell signal number one on the break of that minor wedge. Second breakdown, headed down. 16 is the next target. Regional bank sector continues to move lower at support now, but still looks like it's headed lower to me. PGR, Progressive, and then LQD, corporate bond. So watch this one. This is, I think, also, if I'm right on where we're headed, bigger picture from a macroeconomic perspective, heading into not a soft landing, but more of a hard landing. And more so, if anything, I'm not going to, whether you want to call it a soft, hard landing, my call has been before the bear market even started back in 2021 in the NASDAQ. That was November 2021, technically in the NASDAQ, and right in the beginning of 2022 for the S&P 500. But ever since then, and many times since, I predicted and still believe it will be a much different bear market than just about anybody. I haven't heard anybody, and I'm sure there might be others that share my view, but it'll be a lot different from any bear market in recent history. And that's where I think a lot of analysts and technical and fundamental analysts are having a hard time calling this one, because I've believed it will be a very slow roll and a very prolonged bear market with really with a longer term secular bear market with rolling bull markets in there. We'll have plenty of opportunities to trade on the long side, just like we did back in 2022, catch counter trend rallies and go sector specific and even game the broad indexes at the right times for rallies. But again, I think it's something that's going to play out over many years, not months. Previous bear markets in recent history were measured in months. They were over a year. I'm talking 2007, October of 07 to March of 09, March of 2000 to it was some mid 2002. Those were the last real bear markets, only two in my opinion. Everything else has been a correction, even COVID, even 2022 so far. 2022 I consider the first leg down in bear market. But anyways, those other ones are, went about a year and a half or so, less than 2 years. And I think that's what a lot of people expect. And that's, I think, why a lot of people expect that this bear market, or the one that they considered over in October of 2022, because they figured that's about, as far as percentage drops, it's enough to satisfy everything and price in the raising rates and the inflation and everything else. So, all right, where I'm going is I think this will be another shoe to drop in the financial markets, and that is LQD is the investment grade corporate bond fund. Corporate bonds, investment grade, if you're a triple B or higher, meaning you have the highest rated is triple A and then double A, single A, triple B, then your investment grade. And I've read up that in recent years there's just been an overwhelming majority of the new issuance in the corporate investment grade corporate bond market's been right there at the lowest tier of investment grade quality, which means that if I am right and we're heading into a recession, which is, I believe, inevitable and also imminent, you're going to see a lot of downgrades from this on the corporate debt. And then what happens, it creates a vicious cycle. If you are a bond fund manager and you manage a corp, whether it's a mutual fund, ETFs, and it says by perspective, you have to invest in investment grade bonds. Well, when they lose that, when they're downgraded, your existing holdings, you have to sell them. It can no longer be held in there. It's because it's not a junk bond fund. And so that it's just going to create a tidal wave, a tsunami of selling. And we all know what happens when you have too many sellers versus buyers at any one point in time. that creates a problem. And by the way, guys, it's not just limited to people in LQD. If I'm right, there's going to have huge implications on the stock market, the financial system, because the credit markets are uber important to the whole financial system, including the stock market. And you get those downgrades. Among other things, it raises the cost of capital to those companies, and there'll be a lot of them, a lot of corporations now, when you are no longer investment grade rated. Just like, just telling you how California, I don't know how, got a AA rating with a stable outlook. That'll change, I can almost assure you. And then their cost of capital goes up, because that is what will impact how much they can borrow money for. If you have a lower credit rating, you have to pay a higher rate to your borrowers, which are your bond buyers. Okay, so I'm going to wrap it up here. And the final takeaway on what I was just saying, this is, I always have kind of a mapped out version for how bull markets are going to run in an individual stock or sector, or the markets, as well as bear markets. In bear markets, again, if let me just show you. Don't take my word for it. Let's just go back for a long time and look at a long-term chart of the S&P 500, and or we could look at the Nasdaq 100. But you can see that these drops here. These were the last bear markets. There's the dot-com bubble I mentioned, March of 2000 pop down to 02 lows. And there was the 2007 to 2000, late 07 to early 09 bear market, the last true bear markets. There was Black Monday right there, 20-something% single day drop in the Dow, which, by the way, can't happen anymore with circuit breakers. You can go down that far, just not in a day. And then COVID right here. And so then the takeaway is, in all these cases, you wiped out, in a matter of months, you wiped out years of gains. Back here, during the 2007 to 09 bear market, you wiped out all the gains going back to, if I take that where we were at the lows and just come across here, you can see the last time the S&P was trading at that level was back in early 96. So you wiped out, years and years of gains. And that's, again, how it tends to work. And why? Now, let me tie into what I was just saying about, for example, that whole tranche of triple B issuance and LQD and the investment grade corporate bond funds, because it is then a vicious cycle. This all kind of everything I've been talking about, the problems you're going to read about soon, within the next year or two, with pension funds being grossly underfunded, and then it translates into, as I mentioned, for example, I pick on CalPERS because everyone knows them, they're the biggest. That's the state of California is responsible, taxpayers are responsible for shortfalls. So the firefighters and the teachers get their pension checks because there's not enough money in the investments to pay for it. And so then that, and it just has a domino effect. And so these things tend to unwind pretty quickly. And that's why bull markets, again, they grow, they're slow and steady, but bear markets tend to happen a lot faster because of that rapid change. And again, the domino effect, one thing, it all ties together, everything I'm talking about. Oh, and the last thing I didn't mention, I thought I added it to my watch list, but I must have skipped over it. Then I'll shut up and get this video out to you guys. I'm watching this one. This is IYR, the REITs, real estate investment trusts. And so you can see this one's really coming down hard, headed towards the lows right there. These are targets I must have laid out before, right at the top here, and I haven't modified these notes. I gave you a max stop up here. That was back on January 7th, 2022. I would have put these targets here. Created January 7th. So I gave you 4 targets right when the bear market started. 1, 2, 3 hit. Current final target right there. And then I gave you a potential 4th target. So we hit all 4 targets and then went on to the button. And that's what technical analysis will do. That's, it's just a fluke. Quite often you can call these trends down, not always, but quite often with impunity. And that was, again, called down well before the bear market even started, before, when everyone was bullish on REITs and wanting to buy REITs. And again, it was all priced into everything that was seeing. Now, where am I going with this? Well, this is the REIT sector. these are your, there's different types of REITs, but when you look what's happening here, they're really starting to melt down. So remember, the regional banks, they got in trouble because they hold a lot of the commercial properties, which are sitting empty. It's not, of course, San Francisco's a poster child for that right now, but there are a lot of other areas, New York, everywhere else, big areas, big markets. And so if you look what's going on, and this is why I'm doing the video, and I told you I'm starting to see everything kind of starting to really break down. QQQ still holding that support, but again, the risk of things just snapping here soon and a quick swoon down to my next targets on QQQ and the indexes, I think that's quite elevated right now. So just be careful if you're trying to game a bounce, if you are long, because these are the signs. This is why I'm doing this video. This is why I know it's easier for you guys if I post a handful of charts, but there's so much in here and it's all, again, intertwined. What's going to be the straw that breaks the camel's back? To me, it's never been a question of, is there going to be another straw? The banks that failed earlier in the year, that was just the first of many cracks to come in the financial system, in my belief, and I think some others as well. But you can see you're starting to get some downside traction. And again, REITs are not created equal. Some of them, you have hospital REITs that are going to fare better than office building REITs for sure, right? But you can see a lot of these really just look at this one, CCI, Crown Castle, just really accelerating to the downside here. That's, this one's been chopped in half, and it's clearly in a bear market. Simon Property Group used to be one of the biggest mall owners. I think they're number 2 now, shopping malls. You can see this one, Divergent High, and this one's just rolling over. Got big support here. Once that goes, I see a lot more downside here. DLR, that's Digital Realty Trust. Look at this, Realty Income Corp. Again, this is why I'm doing this video. I'm seeing a lot of this stuff, just like the California muni bond market and a lot of these REITs, just problems. This must be, the smart money finding out, finally these guys were able to, I imagine, like probably similar to the banks, where they can hide and legally obscure losses by marking things to market, or fantasy they call it. They're some of their assets. But something's going on here. That's all I'm trying to say, is I'm seeing more and more cracks. We're not there yet. It's not that all in, short everything you got, mortgage a house. No, but we're, it's incremental, as I told you before. It's certainly worth and has been worth being short recently. And once we clearly take this level out, especially if we can burn through those positive divergences that are forming there, that's going to really help us not completely eliminate. At some point we'll be able to eliminate that, but not when we're in such close proximity to the marginal move high. We start getting down here, we start taking out the 200-day moving averages, and take out my T5 target, then I think that's you'll see that get removed off my my primary board here on QQQ. All right, let me stop the video here, get it out to you guys. So that's it. We're flirting with that key August 18th low right now, and we still have divergences on a lot of the time frames, so there's still the potential if the market wants to mount a counter trend rally, but with more and more things breaking down, it's becoming less and less likely. Okay, I will stop here. This has been Randy Finney with Right Side of the Chart. Have a great day.